Hello, my dear students. A very warm welcome to all of you in Shri Jaindra Rank Zone. I am your friend and mentor for the subject Business Economics. Today, we'll continue with Economics Chapter 5, that is Business Cycles. All the concepts will be covered in the coming series of lectures. So let us continue. This is lecture number 3 of Business Cycles. Let us begin now. So in this lecture, we are beginning with the examples of business cycles. We are going to see three big examples. The first example of business cycles is the Great Depression of 1930. The Great Depression of 1930, let us see. The world economy suffered the longest, deepest, and the most widespread depression of 20th century during 1930. It started in the US and became worldwide. The global GDP fell by around 15% between 1929 and 1932. Production, employment, and income levels fell in the economy. As far as the causes of Great Depressions are concerned, there is a difference of opinion amongst the economists. While the British economist John Maynard Keynes regarded lower aggregate expenditure in the economy to be the cause of massive decline in income and employment. The monetarist opined that the Great Depression was caused by the banking crisis and low money supply in the economy. I believe you understood. Many other economists blamed deflation over indebtedness, over profits, lower profits, and pessimism to be the main causes of Great Depression. Whatever may be the cause of depression, it caused widespread distress in the world as production, employment, income, and expenditure level in the economy fell. The economies of the world began recovering from 1933, increased money supply, huge international inflows of gold, increased government spendings due to World War II, etc. were some of the factors that helps economies slowly come out of the recession and enters the phase of expansion and upturn. Let us note the key points. The world economy, the world economy suffered the longest, deepest, and and most widespread depression of 20th century during 1930. During 1930, it started in US. It started in US and became worldwide and became worldwide. Next noting, the global GDP, the global GDP fell by fell by around around 15%, around 15%. Keynes regarded lower aggregate expenditure lower aggregate expenditure lower aggregate expenditure in the economy in the in the economy to be the cause of massive decline to be the cause of massive decline in income decline in the income massive decline in the income and employment. Next, however however monetarist monetarist opined that opined that opined that the Great Depression was caused by the was caused by the banking crisis and low money supply in the economy low money supply in the economy. Next point, the depression caused widespread widespread distress distress in the world world as production, employment, employment and income level fell, income level fell. The the economies of the world began recovering began recovering in 1933. Increased money supply increased money supply, huge international inflow of gold, huge international inflow of gold, increased increased government spending, increased government spending were some factors were some factors were some factors which helped which helped economies slowly come out of the recession, come out of the recession. Okay, so this was about Great Depression of 1930. Now, now the second example of business cycle is information technology bubble burst of 2000. Information technology bubble burst of 2000. So basically in this the bubble burst of 2000, there was the IT based company, the internet based companies, and a lot of internet based companies started from the year 1997 to the year 2000. The banks were given the low rate of interest, and because of the new venture capitalists enter into the market, many of the company did this startup, and at later point of time, when they were not getting the customers, there were no enough revenues, they did not reach to the break even point, so their fall started after that, and slowly and gradually all these company went into losses, and after that, by one, slowly and gradually, the company started closing down. So let us see the information technology bubble burst of the year 2000. Information technology bubble burst or dot-com bubble roughly covered the period of 1997 to year 2000. During this period, many new internet-based company commonly referred as the dot-com companies started. The low interest rate in the year 1998 and 1999 encouraged these startup internet-based company to borrow from the market, take a lot of loan, and due to the rapid growth of the internet and seeing vast scope in this area, the new venture capitalist invested huge amount in these companies. Due to over optimism in the market, investors were less cautious, and there was a great rise in the stock prices, and in general it was noticed that the companies could cause their stock prices to increase by simply adding an e prefix to their names or .com to the end. So these companies offered their services or products for free with the expectation that they would build enough brand awareness and to chargeable profitable rates for their services later on. As a result, these companies saw high growth because they were offering for free, and a type of bubble developed into the economy. The growth over profits mentally led some companies to engage in lavish internet spending, such as elaborate business facilities, and these companies could not sustain long. The collapse of the bubble took place in the year 1999 2001. Many dot-com companies ran out of capital and acquired or liquidated. Nearly half of the dot-com companies were either shut down or were taken over by some other company. Stock markets crashed, stock market crashed, and slowly the economies began feeling downturn in the economic activities. I believe you understood. The bubble burst of the year 2000 that relates to the dot-com companies or internet-based e-based companies. I think it is clear to all of you. Let us do some quick notings. Information technology, information technology bubble or .com bubble covered covered the period of covered the period of 1997 to 2000. 4 years. 4 years. During that period, during this period, many new internet-based company came into picture. Many new internet-based company were started. .com companies. .com companies. Next, the low interest rates. The low interest rates in 1998-1999 encouraged whom? The startup internet-based company, startup internet-based companies, internet-based companies to borrow from market, to borrow from the market, seeing seeing vast scope of growth of internet, growth of internet, venture capitalist, venture capitalist invested a huge sum of money, a huge sum of money into these companies, into these .com companies. Due to over optimism, investors were less cautious. Investors were less cautious, less cautious. The share price, the share price of .com companies, .com companies were growing in the market, in the market. These companies offered their services for free, offered their services for free, for free, with the expectation, with the expectation that they could build, that they could build enough brand awareness, enough brand awareness, enough brand awareness to charge higher profitable rates, higher profitable rates for their services later, for their services later. As a result, as a result, a bubble developed. A bubble developed in the market, in the market. However, however, the collapse of the collapse of the bubble, collapse of the bubble took place took place during 1999 to 2001. During 1999 to 2001, companies companies could not sustain long could not sustain long could not sustain long and shut down or liquidated. So this was about the big bubble of the year 2000. I believe you understood. Let us continue and see the third point, that is the recent example of business cycle, that is the global economic crisis 2008 and 2009. The global economic crisis of 2008 and 2009. The recent global economic crisis owes its origin to US financial markets. Following information technology bubble burst of the year 2000, the US economy went into recession. In order to take the economy out of the recession, the US Federal Reserve Bank, that is the Central Bank of USA, reduced the rate of interest in the market. This led the large liquidity or money supply with the banks. With lowest interest rates, the credit became cheaper and the household, even with low credit worthiness, began to buy house in increasing numbers. Increased demand for houses led the increased prices for them because the demand was more and the supply was less. The rising prices of the housing led to both household and the banks believe that the prices would continue to rise. Excess liquidity with the banks and availability of new financial instruments led bank to lend without checking and credit worthiness of the borrower, and this was the big fault of the bank. Loans were given even to subprime households and also to those persons who have no income or no assets. There was no mortgages. Households were built in the excess during the boom period, and due to the oversupply of the market, houses prices began to decline in 2006. Housing bubble got burst in the second half of 2007 with a fall in the prices of houses which were held as mortgage. Subprime households started defaulting the bank loan on the large scale, paying off their installments. This caused the huge losses to the banks, and losses in the banks and the financial institution had a chain effect on the US economy, and the world economy at large fell its impact. I believe you understood. The recent global economic crisis, The recent global economic crisis owes its origin owes its origin to US financial markets to US financial markets following IT bubble burst of 2000. The US economy went into recession went into recession. To take the economy to take the economy out of the recession out of the recession, the Federal Reserve Bank the Federal Reserve Bank of US reduced the rate of interest reduced the rate of interest. This led this led to large liquidity large liquidity, or money supply or money supply with the banks with the banks with lower interest rates with lower interest rates. Credit became credit became cheaper credit became cheaper, and the households and the households even led to led to take loans with low creditworthiness. Next point: higher demand higher demand for houses led to higher prices led to higher prices and led both household households and banks to believe that prices would continue to increase in future. They were very optimistic about the future. excess liquidity excess liquidity with banks and and availability of new financial instruments new financial instruments led banks to give loans to give loans without without checking the credit worthiness of the person, the credit worthiness, the credit worthiness of the borrowers. Loans were loans were given to persons who do not have any asset with them, any asset with them. That means they were not having any credibility or any credit worthiness into the market. They have nothing to mortgage. Houses were built, houses were built in excess, houses were built in excess during the boom period, during the boom period, and and due to their oversupply, due to their oversupply in the market, due to their oversupply in the market, house prices, house prices began to decline. In 2006, house prices began to decline. Housing bubble, housing bubble burst in 2007 with fall in the prices of houses, prices of houses, fall in the prices of houses which were held as mortgage, held as mortgage. Losses in banks, losses in banks and other financial institutions and other financial institutions and other financial institutions had a chain effect, had a chain effect, and soon the whole US and soon the whole US economy and the world economy and the world economy at large felt its impact, felt its impact. So this was about the few examples of business cycles. We had seen three different examples. The first example we had seen is the Great Depression of 1930s. The second example we have seen is the information bubble burst of the year 2000. And the third example we have seen is the recent example of 2008 and 9, that is the global economic crisis, which begun in US and slowly and gradually it spreads across the globe. Let us continue with another topic now. Let us begin with another topic, and the topic is features of business cycle. And the topic is features of business cycle. Features of business cycles. So different business cycles differ in the duration and the intensity. So few business cycles were much intense and the other business cycles may be of lower intensity. The duration could be very long, short, medium, anything. You cannot, like, certainly we can't say that this business cycle would be of this duration, but there are certain features that commonly exhibit of a business cycle. The first feature is business cycle occurs periodically, although they do not exhibit the same regularity. The duration of these cycles were different and the intensity of fluctuations also varies. Point number B. Business cycles have distinct phases of expansion, peak, contraction, and depression. These phases seldom display smoothness and regularity. The length of each phase is also not definite. It could be long, it could be short. So you can write over here some business cycles, some business cycles, some business cycles have been long, have been long, lasting for several years, while others have been short ending, in 2 to 3 years, in 2 to 3 years. This is the general perception. C. Business cycles generally originate in a free market economies. They are passive as well. So disturbance in one or more sectors get easily transmitted to all the sectors. Easily transmitted to all the sectors. You can write over here. It is difficult. It is difficult to predict. It is difficult to predict the turning points. It is difficult to predict the turning points of business cycles. Of business cycles. No economy follows a perfectly timed cycle. Perfectly timed cycle. They vary in intensity. They vary in intensity and length. And length. There is no set pattern. There is no set pattern which they follow. Which they follow. Okay? Let us see point number 4. D. Although all sectors are adversely affected by the business cycle, some sectors such as capital goods industry, durable good industry are disproportionately affected. Moreover, compared to the agricultural sector, the industrial sector is more prone to the adverse effect of the trade cycles. Next point. Business cycles are exceeding complex phenomena. They do not have uniform characteristics and uniform causes. They do not have uniform characteristics and uniform causes. So they are caused by varying factors. It is difficult to make an accurate prediction of trade cycles before their occurrence. Before their occurrence. Point number F. Repercussions of business cycle get simultaneously felt on nearly all economic variables. What are the economic variables? Output, employment, investment. That means what? Decrease, a fall in output, fall in employment, fall in investment, decrease in consumption, fall in the interest rate. Still people are not taking the interest, the loans, fall in trade, and fall in the general price level in the economy. Fall in the general price level in the economy. Let's move ahead. Let's move ahead. Point number G. Business cycles are contagious and are international in character. They begin in one country and mostly spread to all other countries through the trade relations. For example, a Great Depression of 1930s in the US and the Great Britain affected almost all the countries, especially the capitalist countries of the world. I believe it is clear. The next point is business cycles have serious consequences on well-being of the society. The society is adversely affected because of the business cycles. Kindly write a note over here. Business cycles business cycles may occur due to external causes due to external causes called called exogenous exogenous factors, or internal causes or internal causes called called endogenous endogenous factors, or there could be a combination of both, or combination of both. I believe you understood. Next point. Business cycles business cycle is wave like full stop. It will have a set pattern. It will have a set pattern of movements. Set pattern of movements which is analogous to waves, rising prices, production, employment and prosperity, employment and prosperity will become the feature of upward movement, features of the upward movement. Falling prices and employment and employment, falling prices and employment will become the will become the features of will become the features of the downward movement, features of the downward movement, features of the downward movement. The process of the process of the process of business cycle, the process of business cycle is cumulative, is cumulative and self self reinforcing, self reinforcing. The the upward and downward movements, the upward and downward movements are cumulative, are cumulative in their process, in their process. When once the upward when once the upward movement starts, upward movements starts, it creates it creates further movement, it creates further movement in the same direction, in the same direction, in the same direction by by feeding on itself, feeding on itself. This momentum, this momentum will persist till the forces accumulate, till the forces accumulate to alter to alter the to alter the direction and create to alter the direction and create the downward movements, create the downward movements, create the downward movements. When downward movements starts, when downward movement starts, it persists, it persists in the same direction, the same direction, leading to leading to leading to the worst depression, leading to the worst depression and stagnation and stagnation till till it is retrieved, till it is retrieved to gain, till it is retrieved to gain an upward movement, an upward movement. I believe you have understood till here. You must have understood till here. Okay, so we stop here. We stop here. We'll continue further in the next class. Thank you.